In this video, we're going to work on problem number 3 in your review for the final exam, which is on basic and fully diluted earnings per share. On January 1st, 2021, Tanj Industries had outstanding 440,000 common shares, $1 par, that originally sold for $20 per share, and 4,000 shares of 10% cumulative preferred stock, $100 par, convertible into 40,000 common shares. On October 1st, 2021, Tanj sold and issued an additional 16,000 shares of common stock at $33. At December 31st, 2021, there were 20,000 incentive stock options outstanding, issued in 2020 and exercisable after 1 year for 20,000 shares of common stock at an exercise price of $30. The market price of the common stock at year-end was $48. During the year, the price of the common shares had averaged $40. Net income was $650,000. The tax rate for the year is 25%. We're supposed to compute basic and diluted earnings per share for the year ending December 31st, 2021, and we're supposed to enter our numbers in thousands. So first, for the numerator for the basic, it's going to equal our net income minus our preferred dividends. It's our preferred. So net income was given in the problem as $650,000. Now we just have to calculate our preferred dividends. So to calculate our preferred dividends, we were told that there are 4,000 shares of 10% cumulative preferred stock. So the par value is going to be 4,000 times 100, and then we multiply that by the 10% rate. So the preferred dividend is going to be calculated as 4,000 shares multiplied by the $100 par, multiplied by that 10% rate. So here, if I take 4,000 shares, multiply it by the $100 par, and multiply it by the 10% dividend rate, I work out to a preferred dividend of 40,000. So my numerator, net income minus preferred dividend, would be $610,000. So for here, for basic, in my numerator, I'm going to put in 610. Remember, it says to put it in thousands. Now, let's calculate the denominator. So we have shares that were outstanding all year. Those were 440,000 shares. And those are outstanding 12 months. So it's going to get a ratio of 12 over 12. Then we were told that the Tanj sold and issued an additional 16,000 shares of common stock on October 1st. So on October 1st, we're going to add another 16,000 shares. So October, November, and December, those get a fraction of 3/12. So to calculate the weighted average, I'm going to take 440,000, multiply that by 12 over 12. Of course, that's 1, so that's 440,000. And then take 16,000. Those are outstanding 3 months, so that gets a fraction of 3/12, 4,000. So we're going to use a denominator of 444,000 shares. So we take our numerator 610, our denominator of 444, and our earnings per share, 2 decimal places, 610,000, divided by 444,000, gives us 1.373, which is $1.37. Now, let's move on to our fully diluted. So for our fully diluted, we have 2 dilutive securities. First, we have the cumulative preferred stock. Now, if preferred stock is preferred stock, it pays a dividend, but if we're going to convert it into 40,000 common shares as of the beginning of the year, it's actually going to be considered common stock, so there's going to be no preferred dividend. So our numerator for fully diluted is going to be the full 650,000. If we had a bond, we would have to adjust for the bond interest, but for the preferred dividend, we're just not going to subtract for the preferred dividend. The other ones that we have are options, and they're not going to make a difference. So let's get started. First of all, we have several things that are going to be all year. So let's note this as our fully diluted. So all year, we're going to have the 440,000 shares that they had outstanding as of the beginning of the year. Then we're going to assume that the cumulative preferred stock was converted into 40,000 shares. So we're going to have another all year of 40,000 shares for the preferred stock. Now we have to assume that those options, the incentive stock options, were converted as of the beginning of the year. So let's take a look at our stock options. So in the stock options, we use an if converted basis. So if those stock markets were, stock options, not stock markets, if those stock options were converted, 20,000 shares at an exercise price of $30 would mean $600,000 come in. So if we exercise those stock options, we have money and we have shares coming in. So the number of shares would be 20,000 and the amount of money coming in is 600,000. Again, that would be calculated as the 20,000 shares multiplied by the exercise price of $30. So if those stock options were exercised at the beginning of the year, the company would have 600,000. Now what we do is we pretend that we used that money to buy treasury stock. We're going to use the average price of the common stock. So we're going to take $600,000 divided by the average price of $40 per year, and that would mean, so that shouldn't have an equal sign, average price of $40. So if we purchase that stock with the $600,000, we would purchase another 15,000 shares. So with the exercise of the stock options, we would increase the shares by 20,000. Then with the purchase of the treasury stock, we would decrease it by 15,000. So the net effect of the stock options is to increase the number of shares by 5,000 as of the beginning of the year. So we have another 5,000 shares for the stock options as of the beginning of the year. Now then we also have to deal with the shares that were issued. So we have the shares that are issued. And those shares that are issued were 16,000. Let me move this off to the right because I'm going to need some room here. So all the things that are all year are going to get a fraction of 12 over 12. So our first three, the stock options, we also assume that they're issued as of the beginning of the year. But our shares that were issued on October 1st, October, November, and December, they're going to get a fraction of 3/12. So now I'm going to take 440, multiply that by 12 over 12. Of course, that's 1. 440, 40, and 5. and then the 16,000 gets multiplied by 3 over 12. So for our fully diluted, we're going to have a number of shares outstanding, 489,000. So for our fully diluted, we take the 650,000, we divide it by the 489,000, and we get $1.33. And I am correct.